Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's Q&A session. And the first question is from Anthony. Anthony writes, first of all, thank you for the information you give out each week. It's made a massive difference to my investment journey. Keep up the great work. Thanks, Anthony. I always enjoy receiving that great feedback, so I appreciate you taking the time to share that. Anyway, Anthony goes on to write, my wife and I recently set up a self-managed super fund and purchased an investment-grade apartment in Melbourne through this fund. We have around $230,000 of funds left over to invest. I'm 56 and my wife is 42. We have 3 other investment properties, 2 in New South Wales and 1 in Victoria. My question is, what is the best way to invest these remaining monies in the self-managed super funds regarding do we put it all in our investment choice in one go, or should we spread the investments over, say, 12 months? Our financial advisor suggested Hub24 managed funds, but after checking the fees, we decided to invest in VDGR, therefore saving thousands in fees each year. The 30-60 split is quite close to our risk profile. This would be our core investment, and we might add some other investments down the line. Do you think this is a sound investment, and how should we go about getting these funds into the investment, either in one chunk or over periods? Your thoughts would be much appreciated on this subject, and thanks again for the stellar podcast. They give me a lot more confidence to learn about this very important subject. Again, thanks very much, Anthony. Congratulations on your investment in an investment-grade apartment in Melbourne. You know my view about where Melbourne sits in terms of the growth cycle, and particularly how I think investment-grade apartments are severely undervalued, and many just sort of trading at land value. You know, you don't even have to pay for the improvements in many situations. So I'm sure that investment will work out really well for you if well selected and held for long enough. Regarding your question, VDGR, that would be a good strategy to do that. Should you invest in one lump sum or over many months? The methodology would be typically that if we're taking money out of one investment and putting it into another, that we should replicate that as fast as possible so that you've got no time out of the market. And the theory is that these monies were already invested, we're just changing how they're invested. So for instance, I imagine you probably, before you went and set up your self-managed super fund, before you went and bought the property, I imagine most of your super was already invested in the market, maybe in the industry fund. You haven't provided that answer, Anthony. I'm just going to assume. But you divested that money so you could set up your self-managed super fund. So the thesis would be, or the generally accepted way of looking at this would be to say that, hey, that money was already invested. All we're doing is just changing the asset allocation, so putting more money into super. So the argument should be that you should just go and invest that money in one chunk again. If you have a look at the stats, and if you look over a very long period of time, whether you invest in a lump sum or whether you invest periodically over a few months, will make less difference the longer the time horizon. So 30 years, it'll probably make no difference. 10 years' time, it could actually make a difference. So I guess if we look to the evidence, which I'm always very interested in doing, the evidence would suggest don't worry about it. Just go and reinvest that money in one lump sum. But you're 56. Let's say you want to have the flexibility of retiring in the next 10 years. Timing could make a big difference in your situation, or a difference, maybe I won't say big difference, but could make a difference. And I think also we've got to consider, what stage of the market we're investing in. Already markets are already at all-time highs. Markets exhibit a lot of risk when they're at all-time highs. When they're attractively priced, after a correction, they're actually very attractive and exhibit much lower risk. So I think in your situation, I'd be investing in stages. Maybe I would invest those monies equally over the next 24 months. And I say that I'd probably take a little bit longer to invest it just because of the Trump factor. I'm sure Trump will do something at some point to upset markets. And then that could be your opportunity to enter in or average down at a lower cost. So I would say, if the market keeps rising, maybe invest, periodically, monthly, I should say, over the next 2 years and spread your investments over that period. If the market was to correct or have a correction, well, then you would take the opportunity to invest more sooner. And that might be a good way of hedging your bets. And I'm not against or I'm not unhappy with VDGR as a core diversified ETF. particularly in your situation, Anthony, where you've put a lot of money into obviously property, you've got 270,000. I actually don't think it's worthwhile paying an advisor to manage a portfolio of only 270,000. So good decision on the Hub24 advisor situation. I don't think it really warrants the fees unless that advisor was doing a whole host of other work for you, outside of super. There is one other opportunity you could use. Host Plus allows you to open an account in a self-managed super fund name. So you could open an account with Host Plus inside your self-managed super fund and put it in, say, high growth or balance, whatever you identify as the best investment option for your risk profile. And then that gives you a way of having a sort of actively managed asset allocation and potentially, something that has some alternative assets and so forth in there as well. Now, I don't think that's materially better than VDGR because you can just set up online share trading account and bang, you can put the money in VDGR online share trading account in your self-managed super fund name. But I just wanted to mention it because it is potentially a relatively easy way, hands-off way of investing some surplus cash flow in a self-managed super fund. Okay, let's get into the next question then. And that's from Mick, writes, he religiously listens to the podcast. I'm driving to work. Thank you for making your knowledge and insights publicly available. You provide a great resource. Thanks so much, Mick. Mick writes, my wife and I accidentally became property investors in our early 20s when we moved interstate for work opportunities and rented out our South Australian properties. 20 years later, we've got 7 properties that are all cash flow positive or relatively neutral. Properties are spread out between Queensland, South Australia, New South Wales and WA. Total value is approximately $5.1 million with $1.8 million of debt. We have approximately $200,000 of savings, and regarding super, we have approximately $900,000 between us. We are both in our early 40s. I have a good job earning approximately $170,000, and my wife works casually, flexibility for family, earning about $25,000. Well, Mick, I mean, you've got a property portfolio with more than $3 million of equity in it, $900,000 of super in your early 40s. You are doing really, really well. Congratulations. Good on you. You've obviously done some hard work, made some sacrifices over that period of time to buy those 7 properties, but it's certainly working out for you. So well done on that. Anyway, Mick continues. We have 2 children, aged 7 and 11. We live below our means. I think that's really obvious in your asset base there, Mick. Yeah. We live below our means and are comfortable. We have the odd situation of renting in a spot that we love, that is very stable and long-term and can't be developed, and the rent is below market value. So obviously it sounds like all mixed properties are investment properties and he's renting in terms of a home. One investment property in a Sydney suburb, it's an older house in an investment grade area / street. It has the obvious potential to subdivide and build duplexes. This is happening elsewhere in the area. Obviously, there's money to be made in the development, but I'm wondering whether there is merit in renovating or rebuilding and keeping the 246 square metres of land as one parcel in the long run. I feel this would give us greater capital growth, and in another decade, these properties will become scarcer. Either way, I don't want to sell that property, but I'm curious to know your long-term view on smaller scale developments versus the option of sitting on my hands and maybe doing a minor renovation and instead investing in a different market such as Melbourne. Okay, it's a good question, Mick. I'll tell you a story about a client that I began working with probably about 3 or 4 years ago now. Probably should do a case study on. It's actually, in fact, I will. It's actually an interesting scenario because we did a bit of a restructure of his business. Anyway, he had this property that was, really mostly land value. Like that, the house was kind of in a bit of disrepair, and there was some circumstances that led to the client owning this property, which aren't really that relevant. But at the time of drafting the plan, the question was, what do we do with this asset? And it had demonstrated pretty strong capital growth up until this time. And so the question was, do we take our money and run, Or do we spend $100,000, around about that, 80, 100,000, I think it was, on the property just to get it up to sort of tenantable standard, knowing that if we went to sell it tomorrow after doing those improvements, the person that buys it is just going to bulldoze it. So we're actually kind of, if you like, wasting $100,000 on this asset just so we can earn a bit of income from it, knowing that, it's not really going to touch the sides and it is a bit of a waste. Okay, and that, just as I'm speaking, that reminds me, that analysis must be done more than 4 years ago because it was pre-COVID. How time flies when you have fun during COVID. Anyway, fast forward to today, that property is worth at least another $1 million than when we did that analysis. In fact, when I work on the case study and pull these numbers out, I'll be able to give you some more definitive numbers. And it's funny because we were reflecting on that conversation with the client last year, in fact. And it made me sort of think, sometimes doing nothing, there's a lot of value to it. So, it could have been easy to give the client advice, oh, yeah, sell it, take some money and run. It's probably not going to repeat the same growth. We can go and reinvest those monies. And you might not have actually kind of revisited that decision, at least not initially. But actually, by holding on to that property and giving the advice to say, no, spend the $100,000. I know it feels like a lot, but, we think this asset really has the attributes to continue to drive growth. So, Mick, I thought that was an interesting story of a client where I've looked back recently, as recent as last year, looked back on the advice and gone, yeah, okay, that was a good decision. I've got on my list, I've done the financial analysis. What I did, I had a look back at some small scale developments that clients have done, some back in, I think, the 2000s and some a little bit later than that. And the theme, I hate to ruin it for everyone, but the theme of that blog episode is going to be, what worked in the past won't necessarily work in the future. And if you factor in the higher construction costs, those opportunities would have been subpar, only a little bit subpar, not terrible, but, it's just not as worthwhile anymore just because construction costs have risen so much. And also the cost of land to get the actual development site has also increased, that they're just less attractive today than they were, say, 20 years ago. So these small-scale developments, they still will continue, of course, because particularly in investment-grade locations, there is value created by, chopping the land up into smaller, more affordable parcels. But I actually agree with you, Mick. I think a 600 square or 640 square metre block in your situation, I think these will become scarcer and scarcer assets. And so I haven't had a detailed look at this particular property, of course, but I'd be inclined in your situation to complete those cosmetic renovations if you need to, try and get it up to speed, but keep the property as is. You can always do the development down the track. And in fact, you could always get the DA to do the development and sell it with a DA. Sell it to someone that's their core business, is developing these properties, because it will be attractive to them once you got the DA, because it reduces the holding costs. They can start work straight away, and you'll probably crystallize, at least 50% probably of the upside equity in doing it that way without taking on the construction risk and all the headaches associated with that. So you can always keep that up your sleeve and do that down the track. But I think keeping that larger parcel of land is probably not earning a lot of income for you. But I guess that's the reason why you've got a diversified property portfolio across 4 different states. And, you're going to have some in there that are performing well from a rental income perspective, some that are performing from a capital growth perspective at different times through the cycles. And it sort of helps you level that out and make those decisions. So I'd be inclined to not do anything or not do too much, particularly given you've described the property as an investment grade location. Okay, next question is from someone that doesn't want me to use their name, which is completely fine. Anyway, this listener writes in, firstly, obviously provides, oh, that sounds arrogant to say obviously. I say it obviously because it's a common theme, but thankfully, provides some really positive feedback and actually compares some of my content to Morgan Housel, which I think is, I don't agree with. I think Morgan Housel's thinking about money and so forth is well more advanced than mine. But anyway, I appreciate it nonetheless. I'm not sure how to tackle this one from this list, and there's a lot of information in here. And essentially the questions are, how is my super balance tracking? And then the other question was really they want to do a renovation to their home, and wondering, is that financially prudent to do? To give you a little bit of an idea of some of the key figures of this listener, family income is about 260,000. One person earning 220 and the other 40. In terms of super balance, combined super balance of about 425 on a wrap platform managed by a financial advisor. Home is worth 2.2 with about $1 million worth of home loan debt. An investment property that they bought in 2009 for 370,000 is now worth 1.1, with about 500,000 owing because they spent a bit of money on the investment property. I want to renovate the home, as I mentioned, and that's going to cost about $750,000. And look, they're the broad details. There's a lot of information here, and thanks for providing the information. I know I've mentioned before, people haven't provided as much information. The downside to that now is I'm getting these questions that are really huge, but anyway, all good. It's fine. I don't, other than preparing a financial plan for you, for this listener, it's a bit difficult to really answer when you ask when listeners ask sort of specific or very broad questions like this. It's difficult to say, okay, yeah, you should, your super's going okay, and you should do the renovations, and this is how you should fund it. Instead, let me talk about a couple of things that just jump out at me. So I said this client has super about 425,000. One account's got 280, and the other one has 145,000 in it. The listener said it's on a wrap platform managed by a financial advisor. Unless that financial advisor is doing something else for you, I just don't think it's worth paying for advice to manage that. And it could be costing you more in terms of fees. It really depends on how those wrap products are set up and what the fees are. But in that situation, if someone approached my office and said, I've got 2 super products, total 425, can we become clients? We would say no. You should just go and set up 2 accounts with UniSuper, or, as I said, I review this every year towards the end of July. But, we've said whoever is the best super fund, which could be Vanguard, actually. We haven't done the analysis, but it could be Vanguard this year. In any case, that's something that you might want to start thinking about. Is it really worth paying a financial advisor for super? And by the way, I shouldn't diminish the quality of advice, or the value of advice, I should say. It's worth paying for financial advice, but not in every situation, right? We need to make sure that what you're going to pay in fees, you will get back in terms of value, and that there's not another cheaper alternative that is just as good. And I think that's a really important point. In terms of renovations to the family home and debt management and those sorts of things, which I think, that's probably the summary of this question, because if they go and spend another $750,000 on renovations, that'll give rise to a lot more debt, which will put pressure on cash flow. And this client's got young children, 6 and 4, so they're not in school yet. No, not both of them are in school yet. And I find when kids get into school, and these listeners' children will go to a public school, it allows expenses reduce, because obviously you don't have any daycare or anything like that, and then allows both parents to go back to work for a longer period of time, do more days per week and increase their income. So the question is, do you go and sell the investment property to fund the renovations, or do you try and just squeeze it in and see if you can manage the cost in terms of the servicing cost of the higher debt? And the listener actually says in about 5 to 10 years they'll get a inheritance as well. Just looking through my notes. Okay, looking through their notes, I should say. 300,000 to 500,000. So the inheritance could knock it on the head, which is, it's one of those things. I did an episode last year, I think it was, should you plan on receiving inheritance? Well, no, you shouldn't plan on it, but you can always keep it in the back of your mind. Given the investment property's done pretty well for you, 370, it's now 1.1, it'll keep ticking along and, it'll be positive cash flow by now because you've only got $500,000 of debt against it, or at least neutrally cash flow. So it's not really costing you any money. I would certainly be inclined to hang on to that property for as long as possible. And the listener mentions something along the lines of, well, maybe we should just give it a go. And if we start to, really strain financially, we can always sell the investment property. Well, that's correct. I mean, that is your fallback position. You've got a plan B in terms of funding the renovations. But, if you've got an investment property, and even if it's an average property, it's not something that's, absolutely shooting the lights out. If you've held it for some time, you're going to pay some capital gains tax. Are you then ever going to be able to get back into the market? If you then get back into the market, are you going to compromise in terms of quality because, you want to be a little bit conservative with purchase price? So that's why, a lot of people say never sell property because, once you're out of the market and to get back into the market again is quite costly. Pay stamp duty, maybe a buyer's agent fee, those sorts of things. So yeah, I would be inclined in that listener's situation to do the renovations. And they mentioned that they're pretty good at managing cash flow, which is positive. And I've found that, just personally in my life, you tend to make it work, right? I mean, a mortgage is really probably one of the best forced savings mechanisms. Now, I don't think people should use it like that. Like, let's go and borrow to my eyeballs so that I do reduce my spending. But the reality is that, you tend to make it work. And when I've made some substantial upgrades to my home that's given rise to debt, and I'm talking, many years ago now, the way I've always looked at it is to say, look, I think it's going to work. I'm pretty comfortable. But worst case scenario is we go and upgrade to this home, we go and buy it, we live in it. If things change and it just becomes, too costly or too tight budget wise, well, in 3 years' time, we'll sell it. And if I feel like we're getting in at the right sort of time, we're not overpaying, and at least if I can just cover my costs and walk away without a loss, nothing ventured, nothing gained. And that's kind of how I've looked at it. And I would say, kind of the same to this listener. It'd be shame to sell a property just to do the home renovations. If you can try and squeeze in both, I'm sure you'll make it work out. Okay, next question is from a listener, Stuart, and he actually spells his name correctly with UART, so good on you, Stuart. Stuart writes, my wife is fortunate enough to work in an industry where she's able to salary sacrifice a portion of her wage, actually $15,900 each year, which she's currently putting into our mortgage. Can you please let me know if she's able to make additional salary sacrifice super contributions, or alternatively, am I able to make additional salary self contributions on her behalf? I'm currently maxing out my contributions. So Stuart's wife sounds like she works for what's called a benevolent organisation, which has different taxation rules in terms of there's no fringe benefit tax if employees' salary sacrifice to different things. Super and mortgages tend to be the two, sometimes cars tend to be the sort of main expenses that people direct these monies to. And hospitals and charities tend to be the ones that are able to utilise these rules. And the whole benefit or main reason for it is that if you go and work for a hospital, while they might pay you less, at least there's some tax benefits and they can try and compete with the public sector in that way. I typically say, put it all into the mortgage, particularly if you've got a non-tax deductible home loan, because not only that's probably the tax effective way of doing it, but Stuart, of course, your wife could make additional super contributions up until the cap. Of course, if she breaches the cap, she can't do that. So I would say, if you're inclined to do that, certainly help her maximise the cap. And then if there's money left over, put it into the mortgage in that way. But thanks for the question, Stuart. Good one. Next question is from Matt. Matt writes in to say that he's currently seeking to purchase an investment property in Melbourne with a budget around $1.2 million as advised by his mortgage broker. I'd appreciate your opinion on what you would consider to be an optimal investment grade asset. And he shared two options. Option one is a single fronted 2-bedroom cottage in inner north suburbs such as Coburg, Preston, or Pascoe Vale. Or option two, a 3 to 4 bedroom freestanding home in the Bayside suburb of Cheltenham or Chelsea, etc. I'm open to other suburb recommendations on suburbs that offer the 1.2 million price point. As an interstate investor, I aim for this investment to be as passive and low maintenance as possible. I'm not interested in strata assets, must be Torrens, title, or and renovated. My primary goal is to achieve the highest capital growth over the next 5 to 10 years, allowing me to leapfrog into my next property. Look forward to your insights. So, Matt, what would I buy? Well, I think I would buy a home. Probably a single fronted 2-bedroom cottage, so something, an older style property. I hear you in terms of low maintenance and renovated, but if I wanted to really maximize the performance of the asset, I would find something that needed a bit of a renovation, but only cosmetic. So only sort of kitchen, bathroom, those sorts of things. I'm not sure I want to go as far out as Coburg. I'd probably try to come a little bit closer, maybe Brunswick, Thornbury, sort of around those areas, as close to the city as possible that budget will allow. I might even go a little further east, a little further west, and think about even sort of Seddon or Yarraville, sort of around about those areas. That's what I would be really thinking about. But you'd want to spend most of the money on land. And I think I would try and counsel you to be open to completing some renovations within that budget, by the way. So you might buy for 1.1 and spend 100 grand on it to give it a bit of a facelift. You probably wouldn't even need to spend that much. I know a client just did a reno of a bathroom and a kitchen, and I think it was about 80,000 or something like that. So, and that was a pretty good renovation. So, you wouldn't need to do that. So that's what I'd be thinking. But most importantly, Matt, get yourself a really good buyer's agent that sort of knows that type of product really well. Make sure you get a referral to a good buyer's agent. You get a recommendation from someone that knows them well or has used them before. And they might be able to suggest some other locations, but that's what I'd be thinking. Okay, next question is from Jonathan. Jonathan writes, not sure if this question is for you or someone like Michael Yardney, but I'll try you first. My wife and I are looking to buy an investment property in the next few years. We'd like to buy an investment grade property, a house preferably, in a good suburb in Melbourne for approximately $2 million. We also want to maximise the rent that we earn on the property, and we also want to be sure that it will always be rented out so we can pass the sleep at night test comfortably. What could be the approach to finding an optimal result of both high growth and high rental income? For example, I would like to buy, as you call it, a jumbo investment worth $3 to $4 million for its high growth, but the rent would be too low compared to the mortgage repayments, and a high-end properties like that charge relatively high rent can often sit in the market for too long waiting for a tenant, and that would be too stressful. I often think that $1,000 a week rent is a psychological red line for many, although that might be higher in suburbs like Brighton, for example. One strategy might be to look at the median average rental price for a house in a good suburb and buy the best price property, or all things being equal, that will attract similar rent. This, I imagine, creates less risk as houses are likely tenanted regularly and quickly at the median rental price. Any thoughts would be appreciated. Yeah, Jonathan, good question. If you go back to some of the blogs that I've done and talked about internal rate of return and these sorts of things, really you need to break this up into sort of two steps. The first step is go and buy yourself some land. The second step is after you've bought the land, go and make some improvements to improve the rental yield. So if you had a budget of, say, $2 million, that might include buying, let's say that budget includes all costs as well. That might mean buying for, say, 1718, and then leaving 100,000 for costs, and then $100,000 to renovate, or something along those lines. You could potentially buy, a terrace house, say in Carlton, for instance. You could do that for around about that budget and still leave some money to improve the rental yield. Thinking about sort of median rental price points and those sorts of things, what you've got to really do is really understand the market and understand who the potential renters are in that particular market. You're going to have different cohorts at different price points. I wouldn't necessarily be influenced too much by the median data. I mean, I did another episode last year talking about median data, particularly suburb level data. It's not always reliable. What you want to do, and this is what a good buyer's agent will do for you, is they're not going to, well, a really good buyer's agent is going to point out that if you go and buy this asset, the rental pool for that particular asset is low. What you want to do is buy something that's in keeping with the area that has substantial demand. And that's going to be different in different locations. Like a weatherboard place in Carlton's probably not going to really work. A lot of them tend to be brick. And so there's going to be, different things in different markets that are going to be important, as well as price point as well. But, this is what people are looking for in those particular areas. So I wouldn't worry too much about, and I'm not sure about the $1,000 a week. These things are pretty fluid. $1,000 a week 10 years ago was really expensive. It's not uncommon today, and so I wouldn't get hung up too much on that. I'd really just be thinking about, where can I find the best quality asset? Let's spend most of my money on the underlying land, because you can never change that post-purchase, but you can always make improvements that are going to improve the rental yield. And then buy something that's kind of been undercapitalized, underloved, something that needs a bathroom and kitchen, maybe put some air conditioning in there, create some sort of, outdoor area. These are the sorts of things that tend to be really highly in demand from tenants, but understand that any particular area might have different things that attract tenants. But make sure you break that up into two steps, because if you try to focus on both these things, both rental yield and growth, you are probably going to make too many compromises. And the issue is that you'll probably make compromises in terms of locality, land size, and land proportion. And as I said, they're the things you can never fix after you've purchased. And so that's sort of my advice or thoughts. But just like I said to Matt, the key thing here is finding a really great buyer's agent. And one that has, a really thorough understanding of these things and that can point you in the right direction, and a buyer's agent that isn't going to be shy at saying no, or telling you you're wrong, or inviting you to take a different approach. Okay, next question is from Daniel about the old chestnut debt recycling. Daniel writes, I have a reasonable amount of equity, more than $1 million, and would like to use my primary place of residence loan to invest in shares through borrowed funds. Are you able to explain the difference in debt recycling versus just increasing the size of the existing loan and splitting out the increased amount to invest for tax purposes? Also, with the second strategy, would this increase the value from day one, or would it simply be when I purchase the shares? I think what Daniel's saying there is, do we progressively draw the loan, or do we take the money out all in one hit? For example, my preference would be to have a $200,000 loan available to invest, and that account would be used to purchase the shares. The loan would be increased only at the time of the share purchase transaction. So, Daniel, in debt recycling is used in lots of different ways in terms of the term is used in lots of different ways. To my mind, it's really about repaying a non-tax deductible loan and then redrawing against that credit limit to use for tax deductible purposes. So, for example, let's say I had an $800,000 home loan and $200,000 in my offset account. Some people would argue, well, why don't you debt recycle that, which is take the 200 out of the offset, pay down the home loan from 800 to 600, and then go and get a new loan for $200,000, back up to the 800 credit limit, and use that 200,000 to invest in the share market. And as you repay the home loan, say in a year's time, you paid another 50 grand off the home loan and the balance is now 550. Well, go and increase your investment loan by 50 in return for reducing the credit limit back to the balance, being 550 on the home loan, and you're gradually kind of recycling the debt. I mean, there's nothing magical about it, right? You borrow to invest in shares. Yes, it might give you some additional income, but you've got some additional expenses, of course, in terms of the interest. And while you get a tax deduction for it, it's likely, I've done the numbers previously, it's likely that it's sort of maybe negatively geared or even neutrally geared. So it's not going to really help you repay your home loan faster. But all I would explain debt recycling as doing is a really tax effectively using the equity in your home to build wealth. And so what you're suggesting, Daniel, is, go and set up another $200,000 loan, split it out, definitely split it out, never mix purposes, tax deductible and non-tax deductible purposes in one loan. So split it out, and you bang on, you would only progressively draw that loan. That is, use the money when you actually purchase the shares. Be careful, though. Most loans are called what's called fully drawn advances, which means that when the loan's set up, they have to draw the loan, all of the loan. That's cool, though. What you can do is, if you set up a new $200,000 loan, that's fine. They'll put 200 grand in a transaction account. On the same day, you take $199 and $900 and put it back into the loan. And so the loan balance, if you like, is reduced to $100. Don't repay the full $200,000 because it will close the loan. And then as long as you've got redraw, you can redraw $10,000 out tomorrow and go and buy some shares and maybe $10,000 per month and drip feed that money into the market. So let's not get too excited about debt recycling. It's really about tax effectively using the equity in your home. Okay, next question. I'm just trying to get through as many of these questions as possible, so I might make these Q&A episodes a little bit longer. Anyway, next question is from Dean. It's a follow-up question to another Q&A episode that I talked about. If you are a non-Australian tax resident, that you are not entitled to the 50% capital gains tax discount for what's called taxable Australian property, which is residential property, falls into that. And as a result, my typical approach, if I have a client that's a non-Australian tax resident, I won't encourage them to invest in Australian property, not unless they're just about to return or it will be a future home. Because one of the things is, if all the gains are taxable and we're buying a property mostly for capital gain, then really half of your investment return is paid in tax. It's not really tax efficient, particularly if you then compare to, say, investing in shares. For an Australian non-tax resident, it typically won't attract any tax. So you've got shares that are tax-free, if you like, property that is heavily taxed. It makes sense. Anyway, what Dean's asking about is he's saying his accountant has told him no, he will get the capital gains tax discount, which I, based on what he's told me, is not correct, or doesn't appear to be correct. But these, to calculate the capital gain and to calculate your cost base and to calculate, how much of a discount you might get, can be a little bit complex. There's so many rules and so forth. So one way to circumvent that and make it nice and easy is just Google ATO CGT discount worksheet. and there is a worksheet that that asks you a whole bunch of different questions and gets you to sort of takes you through step by step to calculate, how much of a discount will you receive. There's also other worksheets, of course, in terms of calculating the actual capital gains tax payable and those sorts of things. And just for Dean while he's here, you could also Google a page called CGT Discount for Foreign Residents. So I jump on the ATO website, put that in the search bar, CGT Discount for Foreign Residents, and that page clearly sets out, what are the discount rules that apply whether you bought the property after the 8th of May 2012 or if you own the property before 8th May 2012. But that worksheet will take you through it. And in fact, there's a lot of resources like this on the ATO website. Be careful, because if you don't know what you're searching for and you don't know the right terminology, it can be a little confusing. But there are a lot of worksheets on the ATO website, and that really does help you out in terms of take you through step by step with these sorts of things to work out the tax consequences. But sorry to be a bearer of bad news there, Dean, but thanks so much for your question and also lovely feedback about the podcast. Okay, whilst I want to try and squeeze in as many questions as possible, I'm probably run out of time. And I'll leave it there, and until tomorrow, bye for now.